We're seeing some choppy trading on Wall Street after Secretary Steve Mnuchin said the U.S. was 90% of the way there on a trade deal with China. Joining us now to discuss is Jason Ware, Chief Investment Officer at Albion Management Group. So, Jason, we're trying to figure out how important trade is to this market right now, given that, that we are getting so many mixed messages. Does the market continue to swing here, or do we just get used to this and figure out how to move on?
Yeah, it's a great question. Unfortunately, I don't have any unique insight into what the market's going to do over the short run, but I certainly think that the trade tensions has created a more volatile environment for investors. And until we get this settled up, it's probably going to remain so over the foreseeable future. I mean, there's no doubt about it that the market cares about international trade, in particular between the two largest global economic powers, the U.S. and China. And there are certainly some downstream consequences in terms of economics and corporate profitability if this doesn't get resolved at some point. So we'll continue to keep watching, and I think we'll be certainly in a volatile environment until we figure out which way this is going to go.
Jason, I think sometimes in these conversations we try to figure out, we try to anthropomorphize the market. What does the market want to do? What is the market thinking about this, that? I mean, what to you seems like, what are you doing right now? What are you looking at and saying, here's something actionable, here's something I need to change my assumptions on, or is it really just waiting for the next Fed meeting?
Sometimes the best action is inaction. And, if you have a good investment portfolio of high quality investments and you have a financial plan and the appropriate asset allocation, typically the best course of action is to do nothing. It's to hunker down and stick to your financial plan and let your portfolio work in service to that. Now, I know that's not a sexy answer, so I'll try to contextualize that with something a little bit more near term. Certainly, the Fed has absolutely become a bigger part of the conversation lately, given the fact that they pivoted twice. You'll recall at the end of last year, they were basically on autopilot raising interest rates. They then became patient, and the market celebrated that from basically what was a 20% drawdown at the end of last year. They've since pivoted again 6 months later to becoming on quote unquote insurance rate cut watch. And we may get one or two rate cuts later this year. So that is certainly taking up a lot of the attention of Wall Street and investors. Meanwhile, the trade fight, the trade war continues. And I think those are the two biggest things that traders are looking to make actionable decisions on.
Okay, so then what does that say about the economy and, most importantly for an investor like yourself, I would imagine, earnings going forward into the second half of this year in 2020?
Yeah, great question. And earnings look to be ticking up in the second half of this year. If you look at expectations on Wall Street, first quarter was about flat, which is a little bit better than expected. Second quarter, the expectation is down 2.5%. Third quarter, the expectation is to flatten out. In fourth quarter, we're supposed to resume growth to the tune of about 6.5%. 2020, the expectation is 10%. Now, of course, those are expectations. They're subject to be revised. They probably will be brought down. Our view is that as long as the macro economy hangs in there, earnings will eventually follow suit. Right now, we're in a 2019 donut hole of earnings growth, basically flat earnings or even a slight earnings recession, not unlike what we saw in Q4 15 that lasted through the middle of 2016. But if you look at stocks over the last 2 and 3 years since that last earnings recession, we're up about 40% on the S&P 500. So I think as long as earnings don't fall apart, they basically hang in there and can continue to grow 2020 and beyond with the macro economy, then I think things will be fine. So earnings should pick up. Earnings of the companies that we own are more secular growth in nature and are growing faster than the market. So that's really what we're paying attention to as our North Star, our portfolio companies, and they're doing just fine.
So let's talk about some of the companies that you like. Playing the hits a bit here with Apple, Amazon, Google, Microsoft. A name, though, that caught my attention is United Healthcare. What do you like about the healthcare space here and them in particular?
Yeah, so United Health Group is the leading player in the managed care market, and that's kind of a boring market for investors. FANG and tech and semiconductors and all these other areas biotech gets so much attention that oftentimes we forget about the more mundane parts of our lives. And United Healthcare continues to be the established #1 player in that market. It's a great business, both on a cyclical basis as the economy grows and people get jobs and they get healthcare. It works for United Health Group. But also outside of their managed care business, we have this Optum part of the business, which is almost half of their revenues and profit at this point. And that is a little bit sexier. This is IT. This is healthcare IT. This is pharmacy benefit management. This is surgical centers. These are basically making electronic and digital health records. They're doing a lot of interesting things in that space. big data in healthcare that I think is really going to move the needle for this company over the next 3 and 5 years. And meanwhile, the valuation isn't terribly demanding relative to the S&P 500, for example, which is growing at about 1/3 the rate of United Healthcare's profitability. So we like that profile to be sure.
Jason, great talking with you. Thanks so much. Chief Investment Officer at Albion Management Group.
Thank you. Appreciate it.